popular sales tactic with whole life insurance involves choosing a 30-year mortgage. Here's typically what it sounds like. You can go with your 15-year mortgage, which you're planning on doing, and that'll cost you $3,000 per month of cash flow. Or you can pick the 30-year mortgage, which will only cost you $1,000 per month of cash flow. Here's what I, the life insurance agent, recommend. Go with a 30-year mortgage, pay only $1,000 per month toward the bank, but then because you were going to go with the 15-year mortgage, that $3,000, you're paying $1,000 toward the bank, which leaves you with $2,000. Put that into a whole life insurance policy. And what should happen, that's the key word, what should happen is that in 15 years, your cash value will be high enough where you can take a loan against it and pay that 30-year mortgage off. The benefit to going with this strategy instead of a 15-year mortgage is that you'll have this big pile of cash inside of a whole life insurance policy, which you've got the freedom and flexibility to access whenever you want. Sound good? My guess is that is probably what you were pitched on or something similar to that back in 1986. I wouldn't know because I wasn't born yet. I was born in 1988. Anyway, the big problem that happens so frequently to so many people when it comes to getting whole life insurance for the cash value is that the policies are set up with a 100% or very high expense ratio. So what that means is when you pay $1 into a policy, your dollar can go toward either the insurance premium or toward what is called your paid up additions rider or PUA rider. Most people are sold policies where all of their money goes into the premium. How you can tell if that's the case is if in the first year, your cash value is very low or a zero, and it takes 10 to 15 years to get your money back, that means the insurance premium is very high, often at 100%. That also pays the highest commission to the agent and agency brokering that policy. Versus a policy that's set up where you, the policyholder, might pay the exact same out of pocket, but where's the money going? The premium piece is reduced as low as we legally can set it per the insurance company limits and IRS limits, which does reduce the commission, but it beefs up your cash value up front. You'll see stronger guaranteed cash values. And when we track the real numbers of policies that have lived the test of time, we see strong returns. It's exactly what we do for corporations, wealthy families, and all of these case studies of whole life insurance where you hear that it works well. I actually included a link to a webinar where we go through several policies from the 1970s, 80s, 90s, 2000s, and the past decade that document proof of actual performance. And a lot of policies we've put in place have been delivering around 5% per year.